Let's get to Tim Edwards, Global Head of Index Investment Strategy, S&P Dow Jones Indices. Tim, this report card you've been bringing to us for about 20 years now, and it's telling us what is the point of the star manager when you can just track the benchmark?
That's right. The US scorecard has been running for 20 years, and 7 years ago we started running a scorecard for Europe as well. So that one's a little bit newer. And look, it is in the short term true that in different times and different periods, different markets see different outperformance rates from active managers. This year's numbers are especially interesting because of the market conditions that they were under. It's not true that active managers underperformed in every segment, but we did see some very striking numbers in the UK.
You called out Poland. That was the exception, the very small Poland equity category. What's different about that? Is it just a lack of information because it's a smaller market?
So you're right. We did call out Poland. Polish active managers did relatively well. They were one of the few categories that saw strong performance. I'm not sure if we should really massively credit them. It's quite a small sample size. And it's quite a sort of small market. However, if you look across across the world and across different markets, we saw better underperformance rates in the US than we've seen for quite some time in the US equity markets. And actually, broad European equities didn't do too bad, or Eurozone equities, I should say, with 57% underperforming. That's not bad.
Morning, Tim. We saw the hedge funds are rounding and looking at short positions on their active managers now, the listed ones on the UK market. That's got to be the right strategy with this underperformance, hasn't it? I mean, what is the point of an active market, active manager, if they can only perform in certain very succinct markets and outperform the indices? Surely most of our viewers are better off putting their money in an ETF or some other form of passive.
Good morning. It is true that the data does suggest that at least a low-cost index tracking portfolio might not be a terrible idea. I think you have to put this in context. So what I think the data suggests to do with the UK, what UK stock pickers have traditionally done is look lower down the capitalization scale, look for smaller companies. And what happened, especially this year in the UK market, is that the really big companies at the top of the UK, international revenues, in the energy sector, in the materials sector, in the financial sector, all those things did really, really well. And in fact, the large cap UK equities market in pound sterling was actually up in the first half of the year, but the small and mid-cap segment did much worse, and I think that is what has, if you like, embarrassed the stock pickers in 2022 so far.
Tim, when will the herd stop hiding behind some... You talked about what they traditionally did, but haven't they traditionally partaken in really what we all know is closet indexation as well, with very, very little differentiation at the periphery as well? Is that still as bad as ever, the old closet indexation?
No, or at least our data would suggest that it isn't. I mean, I mentioned that the UK large cap segment was up. The average UK large cap fund was down and down materially. So it sounds like there actually wasn't enough index tagging in that category.
That's absolutely extraordinary. Tim, we've got to go now, but just to confirm, the more active they are, the less the performance was compared with the benchmark. Well done, active managers on UK.
In the first 6 months of this year, yeah.
In the first 6 months of this year. We love a survey. Thank you, Tim. It keeps their feet on the ground, doesn't it, in active world? I'm sure I've made a few friends today. Tim Edwards, Global Head of Index Investment Strategy at S&P Dow Jones Indices.
I hope they enjoy.